Be Wealthy and Smart, episode 1603.
Step into a world of wealth and financial freedom without budgets, boredom, or bosses on Be Wealthy and Smart. And now, here's your host, Linda P. Jones.
Welcome to Be Wealthy and Smart. I'm Linda P. Jones, America's Wealth Mentor, empowering women and men worldwide to financial freedom. On today's show, we're going to talk about some economic news, like a good GDP report and stocks at all-time highs. The U.S. economy grew at a rapid rate of 4.3% in the third quarter this year, according to an estimate released by the Federal Bureau of Economic Analysis. The estimate was delayed by the government shutdown, but showed that the economy remained resilient over a 3-month period that saw fewer new tariffs announced and consumers shopping for back-to-school goods. The reading covered the months of July, August, and September, and would be the best quarter of growth for the U.S. economy in 2 years since the same period in 2023. Analysts and economists surveyed by Dow Jones had expected a much lower GDP. Instead of 4.3, they were expecting 3.2%. The expansion in economic output, or gross domestic product, was fueled by increases in consumer spending, exports, and government spending. The report said, consumer spending this year has increasingly been characterized by a growing divide between wealthy households that aren't changing their habits amid rising costs of living, and middle and lower income households that have cut back in response to a weaker labor market and tariffs and inflation that both drive up the cost of daily expenses. The overall rate of growth for the first 3 quarters of the year averages out to only 2.5%, however. This is because the economy shrank 0.6% in the first 3 months of the year, before growing by a stronger rate of 3.8% from April 1st to June 30th. For a sense of how that compares to prior years, the average growth rate in 2024 for the whole year was 2.4%. And the year before, the U.S. economy grew at an average rate of 3.4%, fueled by some of the final waves of post-pandemic recovery. One of the biggest drivers of the reading was consumer spending, which rose 3.5% on an annual rate, the best since the end of 2024. The category of services figured prominently in that higher spending, with healthcare and international travel accounting for most of the gains. Within healthcare, both outpatient services as well as hospital and nursing home services increased. Some of this increased spending may be putting households deeper into debt, however. Credit card balances rose by $24 billion during the third quarter for an overall level that was 5.75% higher than a year ago, according to the Federal Reserve Bank of New York's 2025 third quarter data. But consumer spending had been volatile this year, and the softening labor market implies a slower pace of spending next year, Citigroup economists wrote after reviewing the report. Despite the data center mania, investment in non-residential structures contracted at a 6.3% pace, noted Paul Ashworth, chief North American economist at Capital Economics. He said at face value that suggests the AI boom may have taken a step backwards after driving GDP growth in the first half of the year. However, he noted more data may be required before a definitive call. Although some indicators are better than economists projected, surveys measure how consumers feel about the state of economy paint a different picture. The University of Michigan's survey of consumers data for December found that consumer sentiment about the economy actually improved in the first part of this month compared to the same period in November. However, when compared to December 2024, consumer sentiment dropped by nearly 29%. 35% of respondents said that their finances are worse now, 41% said their situation is about the same as last year, and only 24% said their finances are better than in 2024. After this positive economic news, the S&P 500 gained 1.4%, notching its 4th weekly advance in 5 weeks. The Dow and the Nasdaq were also up more than 1% week to date. Tom Hanlon, national investment strategist at U.S. Bank Asset Management, said people are taking profits here and there or buying on lows, but there's not a lot of information. You're not getting corporate profit results, you're not getting a lot of economic data, so it's probably just more technicals and positioning heading into here. He also noted the highs in the market weren't propelled by the technology sector, but rather financials and industrials, two cyclical areas of the U.S. economy. He said that just gives more confidence heading into 2026 that it's not just tech here and everybody behind them. It's the market benefiting from the tax bill that was signed in July, the rate cuts that came in the fourth quarter of this year. Heading into 2026, those are some tailwinds. Investors are also in a historically strong seasonal period as they wait the potential Santa Claus rally. The surge occurs between the last 5 trading days of the year and the first 2 of the new year. Data from the Stock Traders Almanac shows the S&P 500 averages a 1.3% gain during that time going back to 1950. With just 3 trading sessions left in 2025, the S&P 500 traded just 1% below the 7,000 milestone. So without a lot of fresh economic news coming in, the market is rallying on momentum and technicals and anticipation of lower interest rates in the year ahead. So far, everything's looking good for that Santa Claus rally. If you haven't yet subscribed to Be Wealthy and Smart, hit the subscribe button and you'll be notified as soon as new podcasts are available. And all of my podcasts are on my website at lindapjones.com/podcasts. And while you're there, sign up for my weekly newsletter for more wealth tips for your financial freedom. That's all for today. Until next time, live the good life and be wealthy and smart.
Thank you for listening to Be Wealthy and Smart with Linda P. Jones. Share the wealth and tell your family and friends about the show. Check out our website, blog, and social media for more riches at www.bewealthyandsmart.com.